When a giant like Walmart drops their earnings report, you'd think the picture would be pretty clear. But their latest one, it's kind of confusing. They're selling more stuff than ever before, but their profits are actually going down. It's this huge paradox, and that's what we're going to break down to figure out what is really going on behind the numbers.
Okay, let's just start with the headline number, because it's a big one. For the quarter, Walmart pulled in a staggering $177.4 billion in revenue. That's just a massive, massive figure. It shows that their main business, selling things, is as strong as ever.
And what's really pushing that growth is super interesting. Their global e-commerce sales, so everything online, shot up by 25%. I mean, this is not some small side hustle anymore. This shows their digital strategy is absolutely firing on all cylinders.
But this is where it all gets a little weird. Even with those booming sales, their reported operating profit went down by 8.2%. So more money is coming in the front door, but less profit is left over at the end. How does that even work?
Right, so that's the big question here. You've got these incredible sales and this explosive online growth on one side, and then on the other, profits are falling. The data seems to be telling two different stories, which can be really confusing. So let's dig in and unpack what's actually driving these numbers.
So let's begin with the official story, the surface-level explanation that Walmart has given for that drop in profit. Because as you're about to see, it's not quite as simple as them just making less money.
So Walmart is basically saying, hey, this is because of a few temporary one-off expenses. We're talking about things like costs for legal issues, money spent on restructuring parts of the company, and some surprisingly high payouts on insurance claims. You can almost think of these as financial speed bumps, not a fundamental problem with the engine itself. And this is really the key. When you look at the numbers a little differently, the whole story flips. That reported profit, the negative 8.2% number, that includes all those messy one-time charges. But if you look at the adjusted profit, which takes those out to show how the core business is doing, it was actually up, just slightly, by 0.4%. This tells you the underlying business is way more stable than that scary headline number makes it sound. But honestly, this story goes way deeper than just some accounting adjustments. The real answer to this whole paradox is that Walmart is in the middle of a massive transformation, fundamentally changing what it is and what it's trying to become.
See, Walmart is moving away from just being a traditional big-box store. They're evolving into what they call a people-led, tech-powered, omni-channel ecosystem. The big idea is to completely blend their physical stores with their huge online business, creating one single, seamless way for you to shop.
And this is how they're pulling it off. They're using their enormous physical footprint, we're talking over 10,000 stores, as these little local fulfillment centers, and it's working. Deliveries that came directly from a store, that grew by almost 50%. At the same exact time, they're building totally new businesses with high profit margins, like advertising, by making money off the insane amount of customer data they have.
Okay, so now let's get to the really cool part, the secret weapons that are powering this whole transformation. We're talking about two major tech investments that you probably wouldn't expect from your local grocery store.
First up, their $2.3 billion purchase of Vizio. Now, let's be clear. They didn't buy a smart TV company because they want to get into the electronics business. No way. They bought it to put their advertising business, called Walmart Connect, into overdrive.
The play here is actually pretty simple, but it's brilliant. By owning Vizio software, they can take everything they know about what you buy in their stores and combine it with what you watch on TV. This creates a goldmine for advertisers and, more importantly for Walmart, a powerful new profit engine that has way higher margins than, say, selling toothpaste. Their second big bet is all in on artificial intelligence. Walmart is rolling out this new framework of what they call AI super agents, and they're basically designed to make the entire company run smarter and more efficiently.
And look, this isn't just some sci-fi concept. These agents are already making a real difference. You've got Sparky for customers, Marty for business partners, but check this out. The associate agent has already cut the time managers spend making schedules from 90 minutes down to just 30. When you have millions of employees, those savings add up incredibly fast.
And this whole push into high-profit tech isn't just a fun project. It's absolutely critical for them. Why? Because Walmart's entire business model, everyday low prices, means they run on razor-thin profit margins. You compare them to a rival like Target, which has more of a premium feel, and you can see Walmart's margins are just way lower. They have to find new ways to make money. Now, you might be tempted to compare Walmart's profits to Amazon's and think they're getting crushed, but that's not really a fair fight.
because so much of Amazon's profit comes from their cloud business, AWS. As this expert points out, if you strip that away and just compare the retail businesses head-to-head, Walmart's profitability is actually right there with them. It just proves how incredibly efficient their core business already is.
So this entire strategy is really ambitious, and you can bet it's also really expensive, which leads to the big question: does the market actually believe in this transformation? Let's take a look at how investors are feeling about the company right now. If we look at the price-to-earnings ratio, which is just a fancy way of saying how much investors are willing to pay for the company's profits, it's pretty clear they're excited. Right now, Walmart's PE ratio is over 43. That is way, way above its 10-year average of around 29. The market is betting big that this whole tech strategy is going to pay off.
And it's not just regular investors. Wall Street is cheering them on, too. Out of 39 different analyst firms that cover Walmart, a whopping 32 of them rate the stock a strong buy. The professional consensus is loud and clear. They believe Walmart is absolutely on the right track.
So when you take all of this, the massive spending, the tech acquisitions, the sky-high stock price, it all really boils down to one final central question. Is this actually going to work? Can a company that's famous for selling groceries at a low price successfully reinvent itself as a high-tech, high-margin powerhouse?
So in the end, this was never really about one quarter's confusing profit numbers. It's about a massive, high-stakes pivot. Walmart is betting its entire future on building a new tech and advertising empire right on top of its retail foundation. The real question isn't about selling more groceries anymore. It's about whether this retail giant can truly become a tech titan.